Hi, this is Zak Mir looking at some of the companies reporting next week, starting November the 11th. And I'm starting off with Centrica, where we've got what looks like a quite painful topping out process for the shares. Double unfilled gap to the downside in September, then the extended failure below the 200-day moving average now at £3.71, and then the sort of gradual break of neckline support around the £3.50 level. The exact number 350.7, and really the longer the shares remain at below that level, the greater the chance of a full breakdown towards 310 or 320 over the next 2 to 3 months. This right side of breakdown here with the unfilled gaps are very, very negative, and if you add in the triple RSI failures as well below the neutral 50 level over the past month, and you've got a pretty strong sell signal there. So basically, Centrica looking towards the downside, only really back above the 20-day moving average at £3.58 as a minimum would even begin to change the outlook there. Onto another popular blue chip stock, and we've got Sainsbury, where there's been sort of consolidation within a rather strange price channel in place since the end of June, and sort of a bull flag and sort of a range at the same time. The main thing to take away here is probably that support over the last few months is coming well above the 200-day moving average at £3.76. Probably would expect to see an attempt at testing that as support over the next week, even if we're going to head higher. But the overall pattern here does look bullish, and probably eventually over the early new year, you'd be heading up towards that line that I've just drawn from the end of 2012, heading up to £4.30 as an ideal sort of best case scenario target. Only really below the 200-day moving average on a weekly close basis would delay the upside scenario there. On to Barrett Developments, and here obviously we're all very wary of the bubble effect in the housing market, but so far the shares are in consolidation mode after a very sharp rally going into the beginning of this year. Support well above the 200-day moving average at 301 pence. RSI support line in place since August, so it's all looking very, very strong, very, very robust. Would expect really to see a target through £3.50 over the next month, while there is no sustained price action back below the 200-day moving average at 301. So relatively simple picture there. Moving on to Admiral Group, where we've got sort of an attempt at recovery here. The overall picture is that of a rising trend channel since the beginning of March. Support at and just below the 50-day moving average at £12.37, and I would probably want to give the benefit of the doubt to the upside. You could wait for an end of day close above £13, which was the recent November intraday high, and that would also be a break of the 200-day moving average at £12.89. But really, it looks as though while we're above the 50-day line, we will break to the upside and retest July resistance of £14. Just to finish off with a stock which is intriguing to say the least at the moment, and that's Security Group G4S, sorry, the Epicus GFS. Big buy signal here, one which is very, very encouraging, which is the failed gap fill. The low for November so far has been £2.45. The bottom of the October gap was £2.42, so a clear failure to fill that gap. That is one of the strongest buy signals there are in the charting book. That, along with the extended RSI uptrend line running through 45 with the RSI 58, which is ideal for buying, means that we're really targeting the top of a May price channel towards £2.90, and only cautious traders would wait for an end of day close above the £2.60 level of the 200-day moving average, which we are just a penny below. So very encouraging situation to G4S, even though there are the fundamental clouds going on for that stock. That's it for me. See you again next time.